Imagine waking up tomorrow morning, checking the news, and seeing one word everywhere: crash. Markets shutting down, banks freezing transfers, currencies swinging like they're on a trampoline. You look at your bank account and suddenly realize if something goes wrong right now, your money can disappear faster than you can blink. And then the most uncomfortable question hits you, the one people usually ask only during moments of panic. Where can you store value so that you don't wake up with zero tomorrow? Gold. That's what our grandparents, great-grandparents, and basically every generation before us relied on, a metal that outlived empires, wars, inflation, and global crises. But then comes the bold kid of the digital era, Bitcoin, an asset you can't touch, can't hold, that exists purely as code, yet capped at 21 million, and behaving as if it's challenging gold for the throne. So now the real question sounds different. What protects your wealth better today, the metal trusted for thousands of years, or the digital gold invented by programmers after the 2008 financial crisis? The answer is not obvious, and interestingly, it depends not only on numbers, but on how human trust works in the first place. When most people think about reliability, they instinctively think of gold. And that makes sense. Gold isn't a technology, a business model, or someone's startup. It's a cultural archetype, hardwired into the human mind. We trust it not because it's convenient or modern, but because everyone always trusted it. It's generational memory. But we no longer live in a world where value must be physical. Today, your salary is just numbers in an app. Your documents live in the cloud, and your identity is a data packet. Bitcoin became the next logical step in this evolution. If everything around us turned digital, why shouldn't value itself become digital too? Meanwhile, gold remains hostage to the physical world. Mines, extraction, logistics, security, storage, geopolitics. Any disruption, and the price reacts instantly. Bitcoin lives outside geography. It doesn't care where you live, what passport you have, or what your government's economy is doing. And here's what matters most. Bitcoin has a fixed supply. You can discover new gold. You cannot discover new Bitcoin. That's not marketing. That's math. So we're looking at two completely different sources of value: tradition versus algorithm. Trust isn't built on philosophy. It's built through trials. And here, gold still plays the role of the seasoned veteran. It has survived wars, revolutions, defaults, regime changes, the end of the gold standard, and multiple hyperinflations, yet always returned as a safe haven. Bitcoin, on the other hand, is a teenager. Born in 2009, it has barely lived for a decade. It hasn't gone through world wars, decade-long depressions, or a full restructuring of the global financial system. But it has faced one major test: the pandemic. When the world went into lockdown, gold behaved exactly as expected, dipped a bit, then steadily recovered. Bitcoin, at first, crashed together with all risky assets, but then, almost deliberately, it skyrocketed and hit new all-time highs. This is when many people noticed the paradox for the first time. Bitcoin isn't a traditional safe haven, but it recovers faster than anything else. Gold doesn't do that. And that forces us to rethink what safe asset even means in the 21st century. Bitcoin's biggest advantage isn't technology or its independence from governments. It's its brutal, uncompromising scarcity. 21 million coins, not more, not less, not because bankers said so, but because it's hard-coded into the protocol. Even if billionaires, corporations, or governments wanted to print more, they simply can't. Gold doesn't have that luxury. If humanity finds a massive gold deposit on an asteroid tomorrow, supply will rise and the price will fall. This isn't hypothetical. Surprises in gold mining happen regularly. And here's the interesting twist. Bitcoin is mathematically perfect, yet behaviorally chaotic. It still behaves like a risky asset, not like digital gold. But history matters. Gold used to be extremely volatile too. Before standards, before government involvement, before modern monetary systems, gold was far more unstable than it is today. We just don't see it now because it happened centuries ago. Bitcoin is essentially moving through the same maturity curve. Its volatility decreases every year, and if this trend continues, it really can become a full-fledged safe haven asset for the digital age. From the perspective of a regular person, not a trader or analyst, gold feels 100% safer. It's physical, heavy, tangible. You can hold it, hide it, bury it, pass it down. But physicality also creates huge problems. Gold must be transported, guarded, and insured. And if something unexpected happens, war, border closures, confiscation policies, you simply cannot leave with it discreetly. Bitcoin is the opposite. It lives in a world where value can be invisible. All you need is internet access or even just a memorized seed phrase. You can cross a border with nothing but a phone and still carry your entire net worth. Yes, power outages or internet shutdowns make gold automatically more useful, but if we look at real-world scenarios, fleeing a country, migration, frozen bank accounts, sanctions, capital controls, Bitcoin becomes far more practical, not because it's better, but because it was built for a world that keeps changing. It protects you not from physical chaos, but from institutional and systemic risk. A different world, a different type of safety. Gold has long been recognized by the highest financial institutions. Central banks hold it as a strategic foundation, and no global system exists without gold reserves. It's civilization's built-in plan B. But here's the surprise. Bitcoin is following the same path 10 times faster. What took gold centuries, Bitcoin achieved in a decade. Today, we already have Bitcoin ETFs, bank-level crypto custody, institutional holders, countries integrating Bitcoin, and funds adding BTC to strategic portfolios. Bitcoin is evolving from a toy for enthusiasts into a legitimate financial instrument. This marks the shift of an era. Bitcoin isn't killing gold. Gold is simply losing its monopoly. For the first time, the world has two different types of safe assets, one born from tradition, the other from code. This isn't a battle between old and new, it's coexistence. One belongs to the 20th century, the other to the 21st. Once you try to answer the question, which is safer, gold or Bitcoin, you realize something unexpected. It's the wrong question. Gold is a fortress of the past, tested, tangible, intuitive. It protects you from physical chaos, wars, disasters, infrastructure collapse. Bitcoin is a tool of the future, built not for a stable world, but for a world that keeps changing. It protects against inflation, bank failures, government control, capital seizures, and the erosion of financial freedom. They solve different problems, which is why smart investors use both. Gold anchors you in the physical world, Bitcoin anchors you in the digital world. And ironically, it's their differences that make a portfolio stronger. What one can't protect, the other can. The conclusion is simple. The search for a safe haven is not greed, it's human instinct. And in an era of debt, inflation, and geopolitical volatility, that instinct is stronger than ever. Thanks for watching. If you found this valuable, hit like and subscribe.